Here's a question that can completely change the way you think about money. What matters more, starting with a huge amount of cash, or starting with just a tiny bit, but giving it enough time to grow? Most people immediately say a huge amount, but the truth is the exact opposite. And by the time you finish this video, you'll understand why starting small, and even very small, is often the smartest and most powerful financial decision you could ever make. Most people go through life believing that they need thousands of dollars sitting in their bank account before they can begin investing or building wealth. But the biggest secret that wealthy people understanding, and that anyone can use regardless of income level, is that compounding is not driven by the amount you start with, but by the patience and consistency you bring to the process. Because compounding works like a silent machine operating in the background, turning tiny amounts into large ones, simply through the repeated cycle of earnings generating more earnings, and more earnings generating even more, forming a financial snowball that grows bigger the longer it rolls. Compounding is the reason that someone who starts investing with only $10 a week at age 20 can retire far wealthier than someone who begins at age 30 or 40 with hundreds per week earned. Because even though the second person is contributing more, they cannot make up for the lost time. And time, not money, is the true engine behind wealth creation. To understand this deeply, imagine this simple example. If you invest just $10 a week at an average return of 8% annually, it may not feel like much in the beginning. In the first few months, it might even look tiny, almost insignificant. But over 1 year, you end up with more than $500 saved. And with growth, it becomes a bit more than that. Over 5 years, it grows past $3,000. In 10 years, nearly $7,000. In 20 years, over $20,000. And in 30 years, it crosses $45,000. And all of that came from tiny weekly contributions that barely cost anything, showing that consistency can transform the smallest investment into something meaningful. The magic happens because every dollar you put in becomes a tiny employee that works for you, and the interest you earn becomes a second generation of employees, and then a third, and then a fourth, until eventually you have a full workforce of money working quietly for you, even while you sleep, and which is why Albert Einstein supposedly called compounding the eighth wonder of the world, though whether he really said that or not doesn't matter, because the truth behind the idea is powerful enough. What's even more important to understand is that compounding is not about overnight success or fast results. It is a slow, steady, reliable process that builds invisible progress at first and then suddenly becomes very visible later. Much like planting a seed that takes a long time before it sprouts, but once it does, it can transform into something incredibly strong if given enough time. And this is exactly what most people misunderstand. They look at the small beginnings and think it's pointless. But the wealthy look at the long-term result and understand that small beginnings are the only way to reach huge outcomes for regular people who don't have large sums to start with. Whether you're investing through index funds, ETFs, retirement accounts, or any other simple beginner-friendly tool, the key is not the investment type. The key is starting early, staying consistent, and letting time multiply your money. A lot of people postpone investing because they think they need perfect knowledge, perfect timing, or perfect conditions. But this is a dangerous mindset, because every year you wait is a year your money doesn't compound, and once that year is gone, you can never get it back. Think of two friends. The first begins investing $50 a month at age 20 and stops entirely at age 30, investing for only 10 years. The second starts at age 30 and invests the same $50 a month all the way until age 60, investing for 30 years, 3 times longer. But in many cases, the first friend still ends up with more money at retirement, because those first early years gave his investments more time to grow and multiply. This example shows why the minimum amount you need to start investing is simply whatever you can afford today, because it is better to invest small amounts now than large amounts later. See you. And the biggest financial mistake people make is waiting for a perfect moment that never comes. Even if all you can spare is $5 a week or $10 every 2 weeks, the simple truth is that those small amounts will always beat doing nothing. And the habit you build is worth even more than the money itself, because financial success is not built on sudden bursts of effort. It is built on steady, repeated actions that compound over time. You don't need to be an expert to start. You don't need to pick perfect stocks. You don't need to time the market. And you don't need to be rich. What you need is discipline and consistency. And tools like index funds make it incredibly easy, because they let you invest in hundreds of companies at once with very little risk compared to individual stocks. And if you feel overwhelmed or unsure of where to begin, start with tiny amounts in a broad market fund. Set up automatic contributions. And forget about it. Let the system work for you no matter what the daily ups and downs of the market look like. The short-term noise can be scary, but the long-term trend is what matters. And history has shown again and again that markets tend to grow over long periods, rewarding consistent long-term investors who ignore temporary fear.